This Chapter 1 provides an overview of some general considerations the agencies have highlighted as bearing particular relevance to the restaurant sector. The three principal documents we use in this module are Moody's Global Restaurant Methodology, dated June 30, 2001, hereinafter referred to as Moody's 1, the preceding version of Moody's Global Restaurant Methodology, dated June 2008, where it has not been superseded, hereinafter Moody's 2, and S&P's Key Credit Factors, Business and Financial Risks in the Restaurant Industry, dated December 4, 2008, hereinafter S&P 1. These documents and any others we mention in this module can be accessed via links you will find in the course outline that opens if you click the bottom left icon below this video. In total, Moody's rated 33 companies in the restaurant industry globally as of June 30, 2011, defined to be businesses that derive the majority of their revenues from owning, operating, or franchising restaurants, and representing approximately $36 billion of rated debt. The methodology described in Moody's 1 resulted, as of the date of that document, in senior unsecured credit ratings ranging from A2 to CA, with a concentration in the single B rating category. The concentration at this weak rating category reflects the severe stresses faced by many issuers in this sector at the present time. We note in passing that some of the ratings appearing in that publication may have changed since its date. We should explain that the restaurant industry is quite broadly defined by both credit rating agencies. In Moody's 2, the rating agency makes reference to the National Restaurant Association's definition that encompasses all meals and snacks prepared away from home, and ranges from full-service high-end steakhouses to so-called quick-service restaurants, or QSRs, and vending machine companies. Indeed, the company we will analyze in Chapter 4, Starbucks, is perhaps better known for its coffee franchise than for the food it sells. In 2007, a total of 945,000 locations in the United States alone generated industry-wide sales of $550 billion, according to Moody's 2, with full-service restaurants representing $180 billion of this total, and limited service or QSRs another $150 billion. Of the companies rated by Moody's, annual revenues ranged from $20 billion to under $80 million. Geographical scope from global multinationals like McDonald's to entities with only a few units located in a single region, and average checks from around $100 for high-end white tablecloth restaurants to $5 or so for QSRs. The S&P 1 document similarly defines the industry quite broadly and breaks it down analytically into the following three categories. 1. The quick-serve fast food sector, the large majority of which focus on hamburgers, chicken, sandwiches, pizza, or Mexican food, offering typically rapid food preparation and low prices, with or without seating, and for which takeout orders are a large portion of business. 2. The quick casual sector, predominantly in the US to date, bridging the gap between fast food and full service, a sector positioned to generate a higher average check price than fast food chains in exchange for higher quality food, service, and ambiance. And 3, the full service sector, focusing often on ethnic cuisines such as Chinese, Australian, or Japanese, as well as steak, ribs, and seafood. These usually feature moderate to high prices, sit-down service, and serve their meals with china, flatware, and often alcoholic beverages. The rating agencies list a number of key risk factors that characterize the restaurant industry generally and give rise to weak ratings overall. Demand volatility driven by economic and product cycles, exacerbated by fickle consumer tastes in restaurant and food type preferences. Capital intensity, leading to high operating leverage. Low barriers to entry and slim operating margins because of a high degree of competition. High sensitivity to food, energy, labor, and utility costs. And finally, event risk, including in particular the unpredictable and unquantifiable risk of foodborne illnesses such as E. coli and other communicable diseases, which affect revenues and give rise to legal consequences. Factors that work to the industry's advantage include a long-term strong growth trend in eating out in modern economies, the higher disposable income and propensity to dine out of aging baby boomers, the rapid industrialization of China, India, and other countries, spurring consumers towards the adoption of Western dining habits and creating attractive growth opportunities for restaurants, and the industry's good track record in the development of new restaurant concepts and menu items, and its focus on special dietary items, such as healthy foods, to offset price competition from the fast food segment. Beyond these structural strengths and weaknesses of the restaurant industry, the rating agencies acknowledge some 15 or so factors which play an important role in either or both of their methodologies in quantifying the credit capacity of this industry. We mention the most prominent of these next. Both agencies stress the importance of size, diversity, and strength of brand, which together increase the issuer's ability to weather business downturns in a particular region and enhance its bargaining power with suppliers. Lower the cost of key information systems and staff training per capita, and typically enable the company to secure more desirable locations in prime commercial spaces. Both agencies stress the importance of periodic menu changes and the importance of renovating locations to cater to evolving consumer tastes and to allow some differentiation from the competition. And both agencies stress the current difficulties the sector is experiencing as a result of the economic downturn in Western economies, the increase in food prices that is squeezing operating margins, and the impact that higher energy costs are having on consumers' disposable income. As with most industries, however, the relative importance of each risk factor differs, sometimes significantly, between the two rating agencies, and so does the emphasis each agency places on the various components within each factor. For example, S&P stresses the crucial role of managing effectively the logistics and restaurant personnel to ensure adequate and timely supply of food ingredients, labor, and service, and the importance of inventory management and point-of-sale systems to understand which items are in demand. While for Moody's, the quality of management falls entirely outside the quantitative part of its rating approach, although it is included among the 3 qualitative factors that earn a specific mention. And as with most industry methodologies, more than 80% of Moody's final rating score is based on quantifiable measures such as debt service coverage and return on assets, while for S&P, no specific guidance is provided on how the various risk factors are combined together to arrive at the final credit rating. Before concluding this first chapter, we review the common characteristics and alternative business models acknowledged by both S&P and Moody's. Characteristics that apply to the majority of restaurant companies include minimum working capital requirements, extensive use of operating leases, and frequent reliance on franchising revenues via independent operators. Low working capital requirements result from the cash-based nature of many restaurant sales and the perishable nature of inventory. Even when credit cards are used for payment, the establishment receives prompt payment from the servicing bank. The use of operating leases is common in many industries that are heavily dependent on property or heavy equipment. You probably know that Moody's makes an analytical adjustment to GAAP figures on account of such leases by multiplying the rent expenses by 8 and adding the result to total debt, a point to which we return in the final chapter of this module. Industry measures of performance that are frequently used by analysts include same-store sales, calculated as the percentage change in average check, product mix, and traffic or transactions, and also restaurant margins, an indicator of operating performance at the restaurant level before the allocation of corporate overhead and other non-restaurant specific costs. Finally, the use of franchising is common in the industry and warrants a few minutes of our time. With franchise fees and royalty rates in the range of 4% to 7%, the absolute level of revenues under a pure franchise-based model is significantly smaller than system-wide operations would indicate. Conversely, since costs associated with royalty or franchise fees are minimal under this model, operating margins can be exceptionally high. By extension, the absence of an ownership interest in the actual restaurants eliminates the need for capital expenditures for maintenance, refurbishment, or the addition of new units, all of which are borne by the franchisee. Franchise-based revenues are also less volatile than revenues from the operation of restaurants, since payment is normally a percentage of gross revenues rather than operating margins or profits. One drawback of the franchisee model, however, is that the franchisor has no significant tangible asset value, nor the opportunity to generate alternate liquidity from the refranchising of units. Under the alternative model, in which the restaurant is operated by the owner and no franchisee is involved, Revenue generation and operating profit reflect all system-wide sales, so are considerably larger than under a franchise-based model. Margins, on the other hand, are lower since the company incurs all costs associated with operating the individual restaurants and bears the burden of all capex, including maintenance, refurbishment, and unit expansion. Margins are also more volatile since this model exposes the owner-operator to the full gyrations of consumer habits and commodity cycles. The flip side, of course, is that the owner now enjoys substantial tangible assets and can access alternate sources of liquidity through the refranchising of owned units. This completes this brief overview of the agency's approach to the restaurant sector and brings us to the end of this chapter 1.